What's going on, guys? Welcome back to the Rollup TV. It's Thursday. How you doing, Rob? I think we got the closing remarks up for some reason. Putting the US GDP on chain. Yeah, I woke up at like 5 a.m. and I saw that Pith had pumped so much, and I was like, "What's going on?" Yeah, Rob, I think we just need to take a take a redo here on the start here. Um, let's start this over for a sec, all right? All right, guys, welcome back to the Rollup TV. It is Thursday, August 28th. We are live today. We have some awesome guests. We've got our friend Itamar from Ready. We've got Michael from Framework, and we've got our guys from the 𝘱𝘭𝘐𝘗𝘏 Foundation, 𝘱𝑭𝘬𝘬 Labs, Colton. And yeah, guys, we're going to be talking about the next kind of phase of on-chain happenings, which is today we've got the All right, we're gonna just flip the standby, guys. We'll be back in just 1 second. Let's go to standby. Alrighty, we're back. Welcome back to the Rollup TV. Thursday, August 28th. Coming to the end of August here. A couple more days. Pretty cool announcements today with the US GDP. So looking to kind of see what's going on there. Talk about that with Chainlink and Pith. And yeah, Rob, like I said, I woke up and Chainlink and, well, Pith had really moved a lot. 50% higher. Chainlink had kind of got a tiny pump. And yeah, looking to see, kind of understand what happened. So I saw that you put out a tweet about this. Maybe you could just roll through kind of what you saw. I didn't get a chance to look at it, but what is your takeaway here?
Yeah. They're embracing crypto. Crypto is a leading initiative for the U.S. government. I think that's pretty clear. Howard Lutnick, the Secretary of the Department of Commerce, is taking this and spearheading it and championing it. And every time he gets into a room with Trump, he's reminding Trump that you are the crypto president. And so he was in a room with Trump. There was press there. There was media there. He said, President Trump, you're the crypto president. That's why we're publishing federal economic data on chain. And this was part of a broader initiative. The U.S. revised its Q2 GDP numbers to 3.3%. Getting GDP over 3% a quarter is a primary initiative of this administration. There are some other components to this, but it's called the 3-3-3 plan. Bessent has talked about this. We want to bring inflation under 3%. We want to bring GDP over 3%. And we want to get the percent of GDP to the national debt at 3%. It's currently at 7%. And so this is part of a general economic plan for this administration, specifically with regards to bringing this data on chain. We saw the government release this data through oracles. They did it through Chainlink and through Pyth. Chainlink and Pyth brought this data on chain and published it on several blockchains, including ETH, Mainnet, Solana, Arbitrum, Polygon POS, and Optimism. Once the oracles have this data, the oracles already have the distribution across all the chains. So that is the easy part. It's the connection between the government databases, which are legacy and very, very protected, getting the connection between those government databases and these oracles. That's the tough part, and that's what they were able to do. They already did it. They published the revised Q2 metric on chain. I'll tell you what I'm most excited about and why this is particularly interesting. Not only is it a slippery slope for more data, I think the use cases of having this government data on chain are massive. Think about prediction markets for economic data. No more revising job numbers, revising GDP. We're going to have real-time prediction markets that are going to be more accurate indications of what the actual data is. We're not going to have to go back and play with the job numbers or the inflation indices. We can start to have RWA products on chain that is fed data through these oracles, price feeds by this economic data. They're going to be backed. They're going to be priced by this economic data, and we can start to have options and financial products built around this economic data.
Very interesting. Yeah, I mean, I remember when we went to that conference in DC in 2016 together, and the idea that we were having was doing voting on chain. Yeah, dude, that was a whirlwind back then. But
I think I'm glad you brought that up, because I still think about that quite a bit, and I think that is the end game here with adoption from government institutions on chain. Yeah. The slippery slope here, and it's a positive one, is that now that we have GDP on chain and we've established the connectivity between government databases and blockchains, we can start to just load up these chains with data, and then we can create all those use cases. But the cool part is now we can have insight into how money is being spent at the federal level. I don't know about you, but I pay taxes. You pay taxes.
Bro, what?
I'd imagine
How
so.
Are you gonna drop that on me? I don't pay taxes, dude.
Can't speak for everyone. You pay taxes.
Together.
I pay taxes. But wouldn't you want to know
this guy's on one this morning?
Our representatives are spending our tax dollars on. We know that they're
Ukraine.
20% is going to Ukraine, 30% is going to military spending. This much is going to food stamps and government programs. But what if we could see the breakdown dollar by dollar and we could understand the flows? This is what Elon wanted to do with Doge. We didn't know that it was going to, transgender dogs in Gaza, right? No one would have voted for that if we knew it. Now
that's
we
the
can
thing with Doge as well, though, is that
it's on chain.
These transparent mechanisms for governments, they all sound great in practice, but I would push back on the actual, one, how much it changes any real behavior. Perhaps it does if all their actions are transparent, then perhaps there are more repercussions to the actions that government officials will take. But I don't think that posting the data on chain, I think it's more of just building this historical database. And kind of doing so in an experimental fashion rather than like there being some sort of outsized change in the behavior of the consumer but I suppose just having the public information on record that is verifiably persistent over the next 5 years, such that like it can't be changed in history. Because like that's one big crazy thing that I've been wrapping my head around, is like how history is going to be able to be changed based on like who has control over the digital footprint of the entire world.
Right.
So
but it's the tip of the iceberg, man. We're going to build financial products around this. We're going to build applications around this. And to close the loop on that idea that we brought up back in 2018, 2016 in DC, it was the idea that you can now have efficient competition. You can have actual competition between these government contracts. Yeah. It was the idea that if you wanted to fix a pothole, something as simple as a pothole, you could bid on that in your local community versus having to wait for the regional state to send down the contractor and go through the whole loophole. Think about, these guys that are trying to build in after the California wildfires. I've heard they're having a ton of trouble getting permits just to clean up their land. Imagine, and maybe it's because you need to have a regulated, like collection service to come in and clear it and then ultimately rebuild. But why can't we make that a democratized process? Why can't if I have a construction company or if I have these licenses, let me bid on that. Don't close the circle of competition to this inside group that's close to some regulators in Washington.
Let's just zoom through these ones real quick. Actually, you know what? Why don't we get 𝗗𝗬𝗦𝗖𝗟 up here and go through some of these topics with him?
We'll go through the rest of these later.
Yeah, or yeah, we can go through them later. I think 𝗗𝗬𝗦𝗧 is ready to come up from 𝘬𝘵, formerly known as 𝘗𝘳𝗧𝗏. My first DeFi wallet ever. I remember using that all with Compound and that sort of kind of yield farming era. So 𝗗𝗬𝗦𝗧 is in the back. Good to see him up and back on the show.
You used Argent before MetaMask?
Yes, on my phone.
So
Argent was the first was the first that I used on my phone. So yeah, I mean, they're doing a lot of interesting things with regards to Starknet and some of the Bitcoin ecosystem. I'm just curious, like his takes on some of the DeFi stuff that's happening. So we'll get 𝗗𝗬𝗦𝗧 up. Let's bring him up here now. He's in the back, and yeah, let's have our first guest. Let's have some fun today. 𝗗𝗬𝗦𝗧, welcome to the show. Good to have you back on. I think we last spoke about some of the 𝘬𝘵 cards you guys had. Excited today to hear about some of your takes on DeFi. Good to see you again, man.
Hey, Andy. Hey, Robbie. Great having me again.
Yeah, man.
Absolutely. Welcome to the show.
Welcome back. How you doing? How's the last couple of weeks been?
I'm good. Look, I think everyone in the Ethereum space is pretty happy. I moved to Buenos Aires for a few months, so can't complain.
¿Hablas español ahora o no?
I'm learning hard.
Necesitas una chica español para aprender mucho rápido.
Yeah, you're better. I understand that, but you're doing better.
Well, good to see you, man. It's good to have you on. I'm looking forward to Buenos Aires myself. It's going to be a fun week down there.
It will be amazing for Dev Connect. Yeah.
Yeah.
𝗗𝗬𝗦𝗧, one thing I've heard about Buenos Aires, and there's a lot of anticipation for the conference, but it's that people are actually using crypto down there. Like maybe you've been there, only for a little while, but I'm curious, have you had any local experiences with crypto, either stable coins or, generally using this technology with locals while you're in the area?
I mean, it's totally different, at least than Europe and UK. Yeah, it's been only 4 weeks. Crypto is part of people's lives, I would say. And that's why I'm here. We are making a big push for 𝘬𝘵, our neobank product here in Argentina, and people want any way to access dollar. So I think the root cause is more non-Argentinian controlled dollar. Let's say that way. So having access to some form of dollar that is not in the control of the government. There's a big fear here of that, a lack of trust, and crypto is in some way the easiest way to do that. So it's really an important part. You have to understand, people are flying to the US to open bank accounts. Opening a crypto wallet and have some USDT or USDC is quite easier.
Yeah. I mean, there's a street actually called Florida Avenue or Florida Street in Buenos Aires where there's a lot of people who will go around saying cambio, cambio, cambio. it's like Spanish for change. And basically you can go there with different forms of currency and get Buenos Aires currency, pesos there as well.
Yeah, you get your quiver. I have my man now, my contact, I WhatsApp, I discuss exchange rate, and you can actually send them crypto. So you can literally send them dollar in crypto, and they will give you pesos cash or pesos in if you have a local bank account. So yeah, it's really a totally normal way of doing things.
Yeah, it's interesting. It's really interesting. Cool, man. Itamar, I wanted to get your takes on some of the evolution of DeFi today, specifically with what you guys are building, but also just more broadly. We're really entering DeFi's institutional era. I was saying prior to you hopping on that, 𝘗𝗫𝗦𝗏 was my first crypto wallet, like on chain, I guess, back in early 2020 or late 2019 or something. And since then, I mean, it's really changed the entire space as a whole. From your purview, what is the current era of DeFi described as? Right, we've gone through kind of the DeFi 1.0, 2.0. It feels like we're kind of in the third iteration of using DeFi now. A lot of institutional focus. Kind of when you're looking at the DeFi ecosystem right now, which players have really stood out to you, who've done well? What kind of era are we in? What is the new focus for DeFi? Kind of like, lay the land for us a bit, if you will.
So I would say what I see in DeFi, you mentioned institution. What I see at Ready for institution is a bit the same shift, which is we're starting to see adoption of DeFi from people who don't really think about it as DeFi or don't really have a wallet. For us, DeFi was always, you get a crypto wallet, you connect to a dApp, you interact with it. Now you see DeFi or DeFi liquidity moving into connecting to non-crypto, I would say, marketplaces in some way. So when you see Coinbase, for example, integrating more for their Bitcoin loans, you are interacting with a very centralized front entity, a centralized product, but behind the scene, they will leverage DeFi just because it's a more efficient way. And I compare that to what we do now because Ready is becoming much more of a neobank. It stays totally non-custodial, that's the difference. But as a user, they will not think about it as a wallet, as being on-chain. They will not know. And we just decided that the most efficient rail to provide them those services is to leverage DeFi. So I think that's really the change, where DeFi is moving back to really becoming protocols, what they want it to be, and not deal with front end. They're moving from a place where they were both the app and the protocol to really being the source of liquidity for any kind of third-party application. And whether it's good or not, those big distribution comes from very centralized and more traditional players. But I think it's still a big win for DeFi to fuel those players.
Yeah. I mean, I think a lot of the Ethereum people were pretty upset about these recent L1 announcements from these institutional players.
Yeah, I think we saw between Stripe, Circle, I think, made the announcement. People talk about the Google one right now. Yeah. It's an old one. So yeah, I think look, we've seen that phase in the early days. It was the permission chain. Yeah. I don't see that yet as a signal. I see that as big players playing with chains. And then we'll see where it leads. Will they stay L1? Will they become L2s? Will it still even exist in a few years? I think overall it's good that everyone wants to experiment with crypto. It's an overall win. I would rather it being an L2 on Ethereum, but until we see what's their product, we don't know. There's a lot of reason for Stripe, for example, to want semi-privacy to obfuscate that data from third parties, and I could see why they would do it that way. Also, the kind of scaling they need is probably the scale that we don't really have today on L2s. But I'll wait to see what is their L1 before making a judgment.
Yeah, I mean, when I think about some of the products that have gotten success in the space as of recently, obviously, these L1s have been the big announcement. We'll see how those kind of come out of the gates. Stable coins, right? Stable coins, yield. It does seem like there's a lot of demand for just kind of yield products, stable coins in general from institutions. you mentioned this neobank product that you guys are looking to build, right? And I think this all kind of comes along to this revenue meta thing that I tweeted out some months ago. Has your perspective as a builder shifted towards wanting to build this infrastructure, this wallet infrastructure, to now being like, oh, well, look, we need to generate, revenue. We need to build something that has consistent user bases. We need to kind of build this, like, rather than like, I feel like the whole space has gone from like this open source kumbaya vibe to now like a practical era. Like crypto's entering its practical era. Like, what's your take on the practical era of crypto?
So I think there is a change. There are a few changes. I mean, if I take our case a bit different, I think we're just back to the very original vision. You have to realize we started thinking about that in 2017. And what we built back in 2018 was what we're building now, but we realized it was not possible. We couldn't connect to TradeFi, to banking rails, cards. None of what we wanted to do was possible. Scaling was impossible, so we couldn't hide fees, etc. And so now we are more going back. I think there's a shift. Clearly, of course, I think we are realizing, everyone realizing it to be a sustainable business. The crazy valuation you could get on any random token is not totally over, but partially, I think, over, and we judge, I think, protocols differently. I think the biggest shift probably for me is more on the wallet side. I don't think anyone believes that 1 billion people will have a Chrome extension as their wallet. I don't think people will use a wallet. I think they will use an app, a product to have certain use cases, but they will think about it as their trading app or their perp app or their gambling app for prediction market. And yeah, it will just be an app powered by on-chain protocols rather than a generic wallet where people will connect to hundreds of dApps. I think this is clearly changing. You mentioned mini trend. I think stablecoin is probably the best Trojan horse out there. We see totally non-crypto companies embracing them. They are clearly one of the big winners, whether it's Tether or Circle, but even the like of Agora doing very well now. So I think there are several categories of winners in this change. The one that are for me the most impressive is probably Aave and Morpho, that are both really crypto native protocols, but at the same time they are really taking advantage of the adoption by more institutional players. I think that's really good to see.
We're going to hear from Colton from Aave a little bit later in the stream, but I wanted to kind of understand your perspective as you've shifted from one of these browser-based crypto wallets to more of this neobank finance application. And it's still the portal to access most of the DeFi and crypto applications, but it has evolved. Earlier today, we saw Rabbi kind of hint at an announcement or a possible integration of hyperliquid perps. Are you guys also considering something like this, some sort of integrated either perpetuals offering or another decentralized exchange offering, and in general, incorporating more of these DeFi integrations deeper into the Ready app?
So I would say our framework for us is first we think in terms of wallet versus application. Okay. A wallet is a generic signer that will connect to any dApp. Their job is to hold funds, sign, to connect to that. And then you have application, which is an end-to-end use case, whether it's trading, whether it's perps, etc. So that's the first shift happening. Then within that, we think in terms of segment. We have two products. Ready is definitely a much more mass market segment, probably starting with a high earner anyways. A high earner, not yet rich, where we want 100% crypto abstraction. To the point that they might not know it's a stable coin. It's very focused on simplicity for yield, for borrowing, with card and bank account, and rewards. Like competing, I would say, with Amex, where I think by end of the year, you want to be at a point where you download this and it feels like a totally Web2 TradeFi neobank product. But then you have a totally different segment, which is called that Ready Pro, Ready Degen. That's something that is still more being researched, evolving, because our wallet, de facto, we have this Ready wallet with as an extension that by definition is more degen audience. Who uses that is not normie people. And this is, of course, where we explore more those kind of integration, perps, and prediction market, etc. And so I think it's just a natural evolution. Every wallet did it for trading. I think they will realize they need to do it for use cases beyond trading. And so yeah, we are thinking this as different segment. I don't want ready to get perps and to be a super complex product that no one will understand. I want every unbanked person in Europe, so all those people that have been unbanked because they're having crypto. In the US, it's changing. In Europe, it's massive. You have crypto, you get unbanked. Maybe it's not the right term, but you get censored by banks. In Argentina, you have another type of being unbanked and access to dollar. I want all those people to have access to something that feels like a Revolut with much better reward, where everything is in their control and not ours.
Yeah, man. I mean, you guys never really had the app store problems that a lot of crypto apps had, right? Like you guys were always on the app store.
No, we are just good at dealing with Apple. We have, yeah, it's hard. I get a weekly call by a founder to ask us how to deal with that. It's difficult.
Yeah.
It's feasible, but it's difficult. But there's just also common sense. There are stuff that really makes it much harder. Anything on NFT, you have to understand the business model of Apple is in-app purchase for digital content, where they take 30%. Their business model is not to take a percentage of your financial transaction on Robinhood or Coinbase. And so if you touch at anything close to their business model, so NFTs, anything that feels or looks like a game asset, then they will really bite you.
Yeah. I mean, I've just heard so many horror stories of people trying to get their apps on there, getting them taken down, letters, cease and desist, all these different things. So I definitely hear you on the vision of wanting to try to build an application that can solve this banking problem, this access to dollars, etc. And you've just so happened to choose to do that on Starknet, at least in this kind of current iteration of Ready. I'm curious, within the Starknet ecosystem, what applications are you guys using in DeFi to power some of the yield with the neobank or with the Argent card, or sorry, the Ready card? How has that been shaping up?
Yeah, so in Ready, really, we don't think about it as chains. Users will not see any of that probably by the end of the year. Again, there's no chain. They don't care. It's a backend for us. It is actually probably the best backend you can think of right now in terms of price, throughput, settlement time, etc. Then there is, what do we offer to the user? And again, here we really want to abstract all that. That thing today is just easy to do it on Starknet for us because actually there's really good source of yield because there are incentives. As simple as that. Then I think over time there are source of yield that will probably always stay on Starknet. So for example, Bitcoin yield will always, I suspect, will be the best on Starknet for the foreseeable future because they are launching Bitcoin staking. So you will secure the Starknet network with Bitcoin, therefore you will have native yield. And a lot of their strategy is focused on Bitcoin yield, which is very hard to get Bitcoin yield anywhere else. So this, for example, will likely stay. But then we're also launching products that will abstract that. For example, for ETH yield is on L1. I mean, by definition, staking or even restaking is happening on L1. Our vault will take care of that for the user. And then you have something like USDC. I would say right now, probably the best yield is on L1. So our users will be able to have yield from Morpho, for example. It doesn't matter for them that that it's running on Starknet or not. Or they will be able to maybe have a mix of L1, Starknet, and base yield. Again, in Ready, our job is to offer the best financial product for the user. They shouldn't care of any of that. And so the product, we don't see it as a cross-chain wallet. We see it as cross-chain financial products. And if tomorrow the best yield is on some alternative L1, we'll go find it there.
Makes sense. Makes sense. I'm curious, do you guys plan to get a lot of these users from Buenos Aires, from Argentina, into the Ready app while you're there? Or like, who's your target ideal, consumer demographic?
Yeah. So the reason I moved here for a few months is everyone wants to build a crypto neobank. That doesn't mean much. A neobank just means a financial product, basically. There are 10,000 banks in the world. Everyone has different segment, and I don't think anyone really knows where crypto can add the most value. We have our hypothesis, and we're starting with higher earners, with a lot of opportunity to differentiate and to literally beat Amex on the reward model. You mentioned yield earning, stable coin, things like that. So you can hold cash and start earning. It's quite unique to crypto. You need to have a banking license to offer that in traditional world, and that would take a startup probably 10 years to get there. And so in Argentina, we have a single market with super high adoption of new products. They have so low trust in existing institutions that they will try many things. High adoption of crypto, and let's be honest, it's easier, for example, with our card to first target crypto users. They already have crypto, and today our bank accounts are not live yet, so easier to target a crypto user. So I have high adoption of crypto, someone willing to try new products, and then I have big high earner middle class segment. I have a big segment of people who want dollar, which is a strength of crypto today, people who want to work for foreign companies. And I have, of course, a population who is super scared of inflation and suffer from inflation a lot. And so I can test a lot of our hypotheses around segment in that single market. And if you, and you see some crypto products, as you mentioned earlier here, having massive traction. And so we are, with our goal of, I think we can really bring an order of magnitude more adoption because we're abstracting significantly more of the complexity there. But realistically, our biggest market now is not Argentina. I'm here to learn. It's probably still UK, US, Europe. And in 4 weeks, we already found so many challenges with the card. We are about to therefore issue a local card. We will bring the FX pesos USDC outside of the Visa MasterCard loop because it's an exchange that its FX is very complex, high volatility. We will do much better basically by bringing it on our side and hopefully at some point on chain. And so all these pain points, I'm here to figure out how to have really an end-to-end experience that beats any local products, with the goal of probably by DEFCON we'll make announcements very specific to Argentina.
It takes quite a bit to survive in crypto this long. You've been building, since we've been around, for our first crypto wallet. And so what kind of advice, or have you gotten any advice along the way like that has helped you survive in this industry? Because we've certainly seen people crash out. What is some advice that you have gotten or you could provide to anyone who's building in the industry now?
So I think you're right. I think it's probably a miracle. We're still there with high spirit. I think people first need to understand they are not alone. Whether you're a wallet, whether you're even an L2, many L2s have a rough time, but they are not alone. It's really hard for everyone. I think crypto is in search of the various areas of PMF, basically. Where can crypto solve problem? And I think over the past years we started finding some. I think having multiple founders is very important. I always say that the more founders you have, the more likely there's one of them that is positive on that day. The company died the day the 2 or 3 founders are bearish on the same day. I would say add new blood in your team. Don't be worried of losing. It's so long, you will lose people. We have a very, very high retention rate at Ready. But I think having new blood, you get new people with very high energy, and then we motivate everyone. So no miracle advice. It's so hard to keep, especially in bear markets.
Yeah. What's the last thing here for you, 𝗵𝗠𝘠𝘧? What's the kind of current vision for Ready? In 6 months, where do you want to be?
In 6 months, pretty clear. In 6 months, a product that anyone that is not in crypto can join without being scared of complexity, transaction fees, or even without having to learn about 𝘱𝘭𝘢, 𝘱𝑭𝘐𝑢𝑏, 𝘪𝑯𝑑𝘠, 𝑎𝑣𝑒. So fully crypto abstracted product, which was our original vision, that has all the core building blocks of a neobank. We'll have card, bank account, etc. but also that has all the benefits of crypto. So especially around yield, we just launched loans in the app, so you borrow straight, never sell your ETH, never sell your Bitcoin. So I think we'll get, so right now we've been busy adding, and now we'll be busy over the next few months removing everything, like hiding all that complexity. We'll be in a good place by end of year. So I think 6 months is a good target.
Awesome. 𝗵𝘳𝘠, thanks so much for coming on. Really appreciate your hard work and generally being a steward for the industry. You've survived this far, very Lindy so far, so we expect you to survive and keep up the great work.
Yeah.
Awesome. Thanks
I look forward to
Andy.
seeing you in Buenos Aires, man.
I'll be there. I'll welcome everyone. And likewise, thanks for the Rollup to be a steward of the industry. We love it.
Appreciate it, man. Thank you, sir.
Cheers.
Cheers. See you in BA.
BA is going to be a fun time, man. I'll tell you that.
Oh yeah.
That's your next conference, right? Or well, I guess maybe you'll go to that.
We have
SmartCon,
and then the redacted one in September. That one's on the down low. Oh yeah, we're cooking. You know that. You know we're cooking.
Redacted. All right, man. Well, we've got Michael up from Framework. Michael is also a plasma investor. Curious about what his takes are on that XPL pump on Hyperliquid recently. Just general his thoughts around the state of the market, investment focus. Maybe we'll start with some of the more broad stuff about Framework, and then get into this. First time having one of the Framework guys on the show, so looking forward to that and jamming with Michael. We got a good bit of time here allotted, so we'll get him up and let's jump right into it.
Sounds good. Let's get Michael up. I saw. Let's see.
What'd you see, Rob? Actually, let's briefly touch on this Rabby stuff before Michael joins.
I'm curious if they're involved in Hyperliquid as well. Obviously, there's
so Rabby hints at Hyperliquid perp swap integration. I mean, I think Phantom hit $5 billion of volume already in their integration in about a month. So I mean, I put out a tweet today that I was like, look, if I'm Phantom, I'm launching a stable coin. I don't know if that's actually going to happen, or if that's a great idea. Just kind of was shooting from the hip to see what people's reaction was going to be. But yeah, clearly Rabby is wanting to get in on the Hyperliquid train and kind of bring perps into their UX. And if you go on Rabby, you see like there's like the swap interface, which has like, I think a 25 bips fee, or maybe even higher. I think Phantom has like an 80 bips fee. So I mean, it's very clearly this whole like distribution, user relationship, ownership end game is playing out. It's just a matter of kind of who has the best users for this market. Like, I feel like the Rabby users are probably very Ethereum focused. Perhaps they're better for maybe higher value transactions, but maybe are less interested in perps, or perhaps they are. Whereas I think a lot of Phantom users are probably more Solana native, so perhaps more interested in the memes, but also see perps as a better way to kind of like gamble or trade quickly. So look, I mean, I think all of these wallets are going to follow suit of Phantom of integrating some sort of perps. Maybe they integrate prediction markets as well underneath. It's just like this consistent building of the product suite.
I don't know whether Phantom's going to launch a stable coin. I kind of think that's the best business model in crypto right now, next to being an exchange. Everyone and anyone can go and launch a stable coin and probably get a sliver of market share and do pretty well. In Hyperliquid's case, when they're integrating these perps protocols, I saw an interesting stat. Phantom had 5 billion in volume, like you said, and charged, I forget exactly how much they made, but then you had in silico trading from Flood, and he had 7 billion in volume, but half or less of the fees that Phantom was able to generate on less volume. And I think
because they have this referral program.
Well, I think it's mostly because Phantom's users are simply they're insensitive to the fees that they're being charged, because they're buying meme coins and they're like, look, I'm aping in, I'm getting in as quickly as possible. I don't really care about the marginal fee.
Yeah. All right. Well, we got Michael in the back. I'm sure he has some takes on this and just other kind of framework ventures, thesis, ideas, stable coins, DATs. A lot to cover today. So let's get him up. Michael, good to have you in the back. Good to have you on. First time on the show. Welcome, man.
Glad to be here. Thanks for that. And yeah, excited to chat all things related.
Sweet, man. Well, it's your first time. Would love to just get a quick intro about Framework, about kind of your growth story for those in our audience who don't know Framework. I'm sure a lot of us do, but just kind of how'd you get involved? You know, what's Framework all about? What's your thesis? Yeah.
For sure. Yeah. I mean, the quick backstory is Vance and I started Framework 6 years ago. And in 2019, we kind of saw that there wasn't like an early stage venture fund going after the space. We had previously started a startup in the space and sold that. And really we're looking at the landscape, and you didn't really have anyone that was going after specifically DeFi as like the first category. And so we launched our first fund in July of 2019 and kind of like became known as the DeFi fund. It's kind of funny in that sometimes we'll talk to investors now and they're like, oh, you guys are still investing in DeFi? And it's like, well, DeFi never left. It's the only thing that matters right now anyways. And happy to talk more about that. But yeah, we started in 2019 and we've raised 3 funds, and we're continuing to invest heavily. Excited about a bunch of themes, and yeah, the industry feels like it's at an inflection point right now. So it's exciting.
Yeah. I'm curious how you would carve out DeFi, because I think your definition might be broader than some others, like stablecoins, RWAs. All of this is going to go into smart contracts on chain. Would you consider all of this part of DeFi, or generally, how do you define that category and think about its scale?
Yeah. So what I said with DeFi was like the 2019 definition of DeFi, and like Aave, synthetics, Chainlink, the graph, like even back then, Chainlink and the graph were considered DeFi, right? So the definition has morphed, 14 different times. But no, I think what I mean by DeFi now is that blockchains are purpose-built technology for value transfer. What I'd say we don't necessarily have a ton of evidence on yet is can we or should we have data transfer be something that is adjudicated over a blockchain? But value transfer absolutely works. Is this a stable coin? Is it a treasury bond or bill? Or is this just an endogenous token? But like blockchains are built for that. That's all encompassing DeFi. So I don't know, maybe DeFi becomes financial services tech, but like it's all kind of DeFi because it's homegrown from us.
Yeah.
Yeah. Yeah. I'm curious actually just on that, right? Because we saw the US Department of Commerce come out. They're going to publish this data. But what you're saying is that data transfer on blockchain isn't necessarily interesting in and of itself. It's financial products. If we tokenize the GDP or the PCE, then we can create financial products based on that data. That's when blockchain becomes significant and interesting.
Totally. I mean, nobody really cares that we're posting.
I was trying to tell Rob that. I was like, it's not going to change anything. It's just going to be like,
it's about the financial products that we build on top of that.
Yeah,
precisely. Which is, you want to go short long the U.S. Economy, you literally can do that on a purse market pretty soon. I mean, who knows whether or not that's going to happen? But like that's the part that matters. Like, I don't know, client server computer architecture, which is super boring stuff, but like that's purpose built for like communications and content, right? But a blockchain is different in that we have trust and decentralization, which is for value. And I think that's like how we separate the world, philosophically maybe at Framework, but also with our investments. And I think we're just going to continue to run with this whole value transfer element, because in 2019, 2020, when people like our investors were saying, oh, I thought that, DeFi investments were over. It's like, well, Aave is just hitting its stride now. And like some of these platforms that have been around, like Sky, formerly Maker, is just like now coming out of the endgame thesis that it published 2 or 3 years ago. Like this stuff takes a really long time. And I was also talking with a friend about like the 1990s and like the 99 crash and then like the 2000s. And there's so much congruency to what has happened so far here, which is like DeFi started, it crashed, but like you had to have the crash for things to actually get to where they are now, which is productive. And I think a lot of people got blown up in the process, but like the Amazons and the Googles were started pre-crash and they're going to continue forward. So like,
yeah, I think that's a really cool framework for like thinking about it. No pun intended, right? Because a lot of people are thinking short term right now about, is the top in the next 3 to 6 months? Like, are we going to blow off this and that? A lot of us have PTSD Rob and I started a venture fund like a year and a half ago, just prop cap, did a lot of stuff in like late 22 throughout 23, like a lot of like the bigger kind of infra names for this cycle, missed Athena, which is like still scratching our heads on that. Yeah, right. So, you can't catch them all. But now, I mean, even, if we're going to kind of zoom in into this like lens here of thinking about like .com style and like the progression of like the Mag 7 today, kind of reflecting that lens into crypto. I mean, you had a clip I saw from Permissionless talking about kind of like the Mag 7 of crypto is being formed slowly. And I start to kind of think about like, okay, is the last 10, 15 years of venture in that vintage of crypto founders, is that where the Mag 7 is going to come from? Or now that the industry is like really starting to get institutionalized and legitimized, is the next vintage of founders going to be the Mag 7s of crypto? And so, we've kind of put a big pause on doing that many early stage checks for the last like 6 months. Vals went crazy, Comp went crazy. The liquid we knew was going to do well. Obviously, prop cap, we have a bit less size but more flexibility. But I'm just curious, like from your perspective about this kind of lens, like, is this next vintage going to be better than the last? How are you thinking about the venture cycles? We had the L1s, the DeFi, the L2s, the infra. Now we're kind of into the apps, if you will. Just like holistically, how you're thinking about the different vintages, where we're kind of at in the venture cycle. And I would appreciate a longer term view, because I do find that a lot of us get too zoomed in.
For sure. Hopefully it's not too long term. It still has to be relevant and valuable. But I think the like 30,000 foot perspective is that fundamentals are ultimately what matter. And there's basically two categories of investment that you can make, which is L1, and then broadly, let's say like anything that's built on top of L1. And a lot of this is going to be apps, maybe like there's an L2 component, but anything that's built on top of an L1 has ultimately got to be valued based off of the fundamental flows. And fundamentals is profit, cash flow, and flowing back to a token. Now, if you're lucky enough to be considered an L1, what I think of with that is that you have this multi-asset capability basically smashed into one singular asset, which is let's take Ethereum. There's kind of like cash flows and staking yield that you can generate from it. It's a store of value, but it's also a medium of exchange that people are using to pay for things. It's a collateral asset that people will use to borrow against. Like there's so many different ways of looking at that single asset. You can't just look at it as a single thing. And so that's kind of like how we separate. It's like L1, huge outcomes, extremely hard to be considered a legit L1. And then apps, it's sort of like you're building businesses on chain. And so I think, if we were to also put this back into like the 90s and 2000s parlance, in the 90s, everybody went public, or many people went public based off of an eyeballs metric. Like revenue wasn't even, or profit wasn't even considered. And I think if we look back on DeFi 1.0, we're going to ultimately compare that to like TVL. And I think TVL itself is done. All TVL is not created equal, just like every single eyeball doesn't necessarily translate to profit on the bottom line for every company. And I think we got to like move away from that broadly. And if you have like a really successful business model and profitability with that TVL, that's great, but it's got to translate to the bottom line. And so I think we're kind of moving in the direction of there are going to be a lot of things that win, especially at the app layer or built on top of L1s. If you are so inclined to go off and compete against Solana and Ethereum and Hyperliquid and all the majors, even the new upstarts like Sui and Aptos or whoever, Berachain. I mean, if you want to go off and go compete at the L1 layer, good luck, but you got to differentiate and you got to get big real fast. And if not, then it's just kind of a venture landscape. What's your mousetrap and how's it better? But it all comes down to value.
It feels like there's a new category of L1s that's coming out. It's the purpose-built L1s, the Hyperliquids and the Stripes and the Circles. And these are the L1s that have already have a substantial business, they have cash flow, and now they're coming out and they're building their own chain. Do you think these are legitimate L1s? There's a case being made on X that these are going to end up pivoting to L2s. Is that Ethereum cope? Like, how do you think some of these newer purpose-built L1s play out?
Well, everybody is going to have the same playbook, which is how do you become, and you could say, some people would say, how do you become the next Bitcoin? Some people would say, how do you become the next Ethereum, just as the top two assets. It's probably some combination of the two, which is maybe it's Stripe who has, for the first time ever in the crypto space, the distribution to be able to get the broad reach to actually build a legit L1. But once again, an L1 in my kind of valuation heuristic means that you've got a platform that makes money, you've got an asset that can be used as a medium of exchange or a stakeable component, and you've got an asset that people want to use as collateral. And so like all of these things combine to create a successful L1. Stripe may be going off and doing the distribution first methodology. Somebody else like I think Arc with Circle, they may go off and try to build, like, I don't know if you remember this, but like Silvergate Exchange Network, like a kind of like an internal, like an intranet for banks. And that may be their beachhead in. But I do think that if you're going to go up against Solana or Bearchain or any of the new ones that have launched recently, like what's your tech differentiation? But ultimately everybody has the same playbook, which is how do you go and become Ethereum?
Yeah. Yeah, I wanted to bring up something that is a little bit kind of tangential to the L1 stablecoin conversation, which is as of recently, and I've seen Vance tweet about Plasma and Hyperliquid like no other, and we happen to be investors in Plasma, also very early to Hyperliquid here. And so just recently this week, Justin Sun decided it was a good time to blow out a bunch of shorts on the XBL pre-market on Hyperliquid. And my question to both of you guys is actually more about the precedent of rollbacks and of managing user capital than anything with regards to the valuations or anything, which is previously Hyperliquid had this Oracle situation where this really small token Jelly pumped up a ton. Then they rolled it back, basically called it an Oracle exploit, refunded the HLP vault holders. So basically like their core business, the HLP vault, didn't have any lack of confidence going forward. If there's any sort of, slight erosion of confidence in that vault, I think it really affects a lot of the entire premise of the whole platform. This time, the people that got blown out were pretty much people trying to hedge their Plasma token allocations. In fact, some guy came out publicly and said like he got blown out for like 2.5 million, a pretty famous crypto Twitter whale. And people were actually upset. I saw a big long post from a fund saying that, guys, like, you guys rolled back Jelly, but you didn't roll this back. This is a clear manipulation of a specific problem on Hyperliquid, but not on other exchanges. So, meaning that this happened on Hyperliquid, but the other exchanges' prices didn't change in the same way. It's now settled out around like 6 or 7 billion FDV, 66 cents, 70 cents. So the question to you guys is like, should Hyperliquid have rolled this back? Or like, how do you, as a kind of a permissionless network trying to, facilitate value, how do you think about your users on chain and kind of these types of activity? Is it something that should be, spoken against? Should it be banned? How do we think about open markets in relationship to keeping your users happy and profitable? And yeah, Michael, please take it.
It is not. It's not an easy answer. And that you can't do this every single time someone claims foul, because then there's no stop in place. And look, the Jelly situation was an Oracle manipulation. And I think what is extremely difficult with either low volume assets or pre-markets in particular, or more so, is that there's no reference price. Like nobody knows what the value of Plasma is. Is it the 5 cents that Founders Fund did in the last round? Well, obviously not. There's a market for it now, which is a pre-market, which is not something that is tied to what other exchanges are quoting as their pre-market price. And each exchange is going to have a separate and different market for how this asset should be traded, because you're not actually trading the tokens themselves. You're trading pre-tokens. And so it's kind of like this isn't even XPL. This is an asset that is specific to Hyperliquid or specific to Binance. And the market is the market. And if you're going to try and short it and you're going to keep those orders in, and somebody decides to blow them out, like, you have to know what you're getting into. And, you know, no crying in the casino, I get. I do think that where there is a difference with Hyperliquid in the role that they played in the jelly situation is frankly something that they should have taken down as a market before. It was too illiquid. It was, you know, not even close to being one of the top markets. I think it was on like the 3rd page. And so I think that that's where they kind of admitted fault in some ways, and that, hey, we need to do better about clearing markets that don't have enough volume for us to maintain this and subject the HLP to, you know, the losses as they did. So that's what they did. And remember, they pay back the HLP. They didn't pay back users that lost money. And so that's also a different situation, which is sort of like, it's their users. It's not people who are putting on shorts. And so I think that right now they're kind of handling this stuff really well. People are going to be upset on either side, but if you're going to try and hedge your free airdrop position and you get blown out, I really don't have any, I don't feel bad.
Yeah. I think, you know, they, like you said, they set a precedent, and to me, if you do it once, you kind of got to do it again, unless there's some external forces at play. I'll keep my answer pretty short here. Like, let the hype stakers vote on it is my perspective. Like, why not? That's how we determine that Ethereum Classic exists, and we should, you know, blackball the hacker, the DAO, and basically blacklist their tokens. All the Ethereum holders were able to vote on it. It was a social construct that we were all able to come to a social consensus. And I think that is ultimately, like, that is the consensus here. Maybe it's 4 validators in Hyperliquid, or it's a lot more in Ethereum back when it was even proof of work. But ultimately, I think most of this, when it comes to forking, and that's kind of what happened, it was almost like a soft fork in Hyperliquid's case to choose to or to not. Let the people speak their mind with their tokens.
Are there other precedents within Hyperliquid of them using the token to vote on situations that the exchange decided?
No, that precedent, I don't believe so.
So that's also a dangerous precedent set.
That's accepting a governance protocol that they may or may not want for themselves. And yeah, that is setting an entirely different precedent. And I think you're trying to talk, but you're on mute.
Yeah. You get into the layer 0 wormhole debacle of is DAO governance even really valuable when it's really owned by a couple people, right? So.
Well, yeah, it's just like, are we going to decide on everything as a token vote holder?
I mean, are you even going to vote, right? Are you really going to pull your ledger out and vote? You're probably not. Right. So.
If it matters to you, you might, right? Justin wants to keep it. Michael, I got a little bit of a different kind of question, but it is still in this, you know, on a similar note. I was reading through Arthur Hayes's essay, essentially, for valuing some of these things. And I'm curious if the way he describes it, would you agree is the right way to think about this? We have, based on Bessent, the Treasury Secretary is projecting $3 trillion of stablecoins by 2028, end of Trump's term. And Arthur goes through this valuation heuristic, to use that same term, of, okay, if we have this much stablecoins in circulation, we're able to derive this average volume based on the amount of stablecoins, and then from that back into a revenue number. And then he used this to extrapolate like a 56x in Athena, 126x in Hyperliquid. Like
the best bag pumper ever, man. This guy.
If you believe that the growth of stablecoins is going to grow the use of these protocols and therefore grow their revenue and therefore grow their valuation, then the math adds up. But when you look at just the face of it, 126x multiple, it sounds ridiculous. So where's the broken logic here?
It's like I did investment banking for a little bit, and in many cases in investment banking, you're told what number to find, and then you go and back solve for that number. Look, I think it's not exactly that, but it is. Let's find the most bullish methodology we can possibly come up with. I also think anyone who's doing like a discounted cash flow is, on the flip side, completely wrong equivalently, because a lot of these things are either priced in the native token, which they're earning in and of itself, or the native token is automatically buying back being bought back by the cash flows, which is not a distribution of cash flows that you should discount to some interest rate. So I would say there isn't a right answer, unfortunately, and that it's somewhere in between. It's somewhere in between, like it should be worth X based off of cash flow Y. And I think if we look at like the price to earnings of the S&P 500 right now is something like 22. I haven't checked it in the last week, but let's say it's 22. And there's some really non-growthy companies and really kind of uninteresting businesses in that. And so maybe the right price to earnings is something like a 2x, because we're growing on average 2x more as an industry than the entire S&P 500. Maybe it should be a 3x. But if we're talking about, let's say, an annualized rate, let's say Hyperliquid, for instance, Hyperliquid is now buying back 99% of the revenue that it generates, or it will be soon, annualized. And sure, this is not like perfect annualized because it is increasing over the last few months, but they're at, let's say, conservatively $1 billion a year, priced at 46, I think 47 billion FDV. Do I feel comfortable buying that at a 46x price to earnings when the S&P is trading at half that? Yes, absolutely. Especially when their annualized number as of closer periods is much higher. And you've got things like HIP3, like all of these factors kind of coalesce into the same thing. But the other thing that I think is important to note is like, this is all over the long run, what should be fair market value. And there's like in the short term, it's a voting machine. In the long term, it's a weighing machine, or vice versa. I think broadly, it's all about the flows in the short term. So where is that new digital asset treasury company going to get announced, and who's going to be buying $1 billion of a $10 billion asset because of that DAT? Like, guess what? Price. That's a train going down the tracks that you want to get out of the way of. So I think short term, it's all about the flows. Long term, there is like a valuation methodology that you think about, but it's some price to earnings that's much higher than public comps.
Let's talk about the flows then, because as of today, and I appreciate that, it's great to hear a venture capitalist speaking about venture capital who is excited about Hyperliquid. These can be rare these days. Truly the people's coin. But kind of looking at the flows, I think as of today, actually, as per some of the Blockworks research, 5 of the 8 Ethereum DATs are trading at MNAV or below. So we're already seeing over a majority basically having no more ability to issue shares at a higher rate. They're now going to be trading in discounted territory. And it kind of begs the question of like, is the majority of this Ethereum run already behind us, right? Or like, how much of this DAT bid can be sustained going forward? I'm curious what you guys think. Like, I put out a poll: what inning are we in of the DAT kind of mania cycle? And I put 2nd, 4th, 6th, 8th. I think it ended up being 6th as the leading projection here. But Michael, when you're looking at the flows, with this stat in mind for Ethereum, how are you thinking about the flows in DATs for ETH? Also, MicroStrategy's MNAV has just been trending down for about the last year. Is at about 1.9. I think we're closer to 1.6 as of today. How are you guys thinking about this?
Yeah, great question. So I think let's separate out basically Bitcoin and Ethereum, or strategy and all the Ethereum DATs. On the Ethereum front, or actually on the Bitcoin front first, I think there's been, broadly, August is like the slowest month in Wall Street, and even more so than December. And you get, most people are gone. So there's basically no new issuance. There's no new kind of like productization that you're going to expect to happen. But today's Thursday, the 28th, and we're coming up on Labor Day pretty soon, and like, get ready for September. Because I bet that there's going to be a lot new issue in September, especially as they start to look into some of the preferred options. So Saylor changed some of the interest rate or the dividend rate for STRC, I think earlier today, which makes it more attractive. I bet he's going to be able to issue a lot more of that. I also wouldn't be surprised. He also changed the ATM capabilities for him to issue new common. And the big thing that I think is people are waiting on, and it's really not a question of if, it's more a question of when strategy gets added to the S&P 500. And there is, I believe, a date of September 12th, which would be kind of the next potential available option. If not that, I would look to maybe December or January. But expect that this will happen at some point. And at that point, everyone's 401k in the United States has Bitcoin in it.
That's insane. It's like the classic vampire attack.
Truly. The other element, which I find super interesting, is the Norwegian sovereign, sovereign fund. They announced that they had bought a lot of Bitcoin, I think in Q2. But when the filing came out, it was really interesting because they didn't own any ETF and they didn't own any Bitcoin itself. They owned strategy shares. And so there's a lot of sovereign wealth funds who are looking at strategy as basically a higher Bitcoin per share amount than you'd get in IBIT. And so there's a real kind of advantage, I'd say, with that, which is why it still trades at a 1.7 or 1.9 MNAV. And look, I think the standard rate for these is going to be somewhere between 1.5 and 2. And so if we're in that range, that is awesome.
We're cooking, yeah.
We're cooking big time.
Yeah.
To the tune of billions or tens of billions of issuance in the next 12 months. Now, when it comes to Ethereum, what happened yesterday with BitMine in particular is that it hit the second half of its unlock. So it sold off, I think, 6 or 7%. Today, it's down another couple percent. SBET kind of holding in there, but it's already through its unlock. And so Ethereum is now getting to that like maturation, or the Ethereum DATs are getting to that maturation point where, and in reality, there's only two that matter, because what you need to get to is that $10 billion mark so that you can do a $1 billion+ bond issuance or convertible note issuance. And that's ultimately what everybody's playing for. I think BitMine is something like 1.8 million ETH. And so, 4,500 ETH, we're getting close to that $10 billion mark, which as soon as they do that and they issue, convertible notes, they're buying $1 billion worth of Ethereum and they're not diluting the shares, which is huge. So I would say we're kind of at the end of the first sell-off of the Ethereum DATs. Keep in mind, these things were announced and launched in the last 75 days. So this is just getting started. And so I think there's going to be tens of billions of purchasing that happens from the Ethereum DATs by the end of this year. So just to say that again, tens of billions, over 10, which at current prices, I think would be like 7 to 8% of all ETH. And that's going to come from 𝘗𝘳𝘃. It's going to come from, I can't remember the name of Andrew Key's DAT, but it's going to come from that. It's going to come from Sharplink. It's going to come from BitMine. And it's going to be a mix of both equity issuance and debt issuance. So we got a long way to go. And yeah, if you were to ask me the question of, what inning are we in, I'd say whatever E, F, whatever is not listed as the first inning.
Well, get out of the way, baby. ETH BTC to 0.08 is coming then, huh? My goodness. So just a quick note there that I think is going to be new for our audience and is new for me. Once a treasury company gets over $10 billion of the underlying asset that they're accumulating, they can then basically issue debt against that versus having to go and kind of do this ATM pipe strategy. They can go and basically do like the sailor strategy after they get that $10 billion mark. It's not a
hard and fast rule, but what you need is support from an investment bank. And you can find smaller boutique investment banks who can do hundreds of millions of dollars of debt issuance, but the large banks only want to do billions. And if you're issuing debt, there's sort of like a debt to asset ratio that you want to maintain. Rule of thumb would say the first debt issuance is less than 15%. So maybe you do a $1 or $1.5 billion debt issuance, but that's only if you have a $10 billion company.
Right.
So it's sort of like okay, get to that level. Congrats, you're there. Banks are interested. Let's do some debt.
Mm-hmm. And one more mechanism at play here is this unlock that you said sort of led to this sell-off in BitMine. Could you explain like what is getting unlocked? What do they sell for anyone who's unfamiliar?
Yeah, so the unlock, I mean, I said unlock, it's really a share registration. It's where anyone who is a PIPE investor in the original PIPE, there are certain dates after that PIPE closes where a certain percentage of your shares are available for registration. Once they're available for registration, it's like you get liquid assets and you can sell them. So in crypto, we're used to like, okay, maybe investors get like a third after 12 months and then it's monthly for the next 2 years. Imagine you get 50% after 30 days and then 50% after 60 days. And that's what just happened. So like the fact that BitMine didn't sell off 20% is extremely bullish. Also keep in mind, I think the shares, I want to say they're at least over 10x in terms of, because I think it was $4.15 was the original PIPE. And I think they're still trading over 40. So
what you're saying is that these PIPE vesting schedules are more like KOL rounds than traditional VC.
I mean, look, an IPO fully unlocked 6 months after the IPO. So like, I don't know where we came up with vesting over multiple years, but that's not how TradFi does it.
Yeah, no, I just think that the pushback that people are giving now for like the sold ads is that, you know, investors are putting up locked tokens. That's kind of like where like retail doesn't win. There was a clip going of Jonah from the 1000X pod talking about it. And I think that's where some of the pushback is coming from. But I don't think that's just not happening on Ethereum and Bitcoin. They're much more cleaner.
Ethereum and there is no locked Bitcoin.
Yeah, exactly, which is great.
And just to comment on that, I think if you are putting in locked assets, you are getting a lower dollar value because of that.
How steep is that discount?
Yeah,
if you've seen that,
but it's fair market value, so it gets valued by somebody else. You can't just like count one for one if you don't have access to the asset.
Yeah, and when you're speaking to like your LPs or, you know, people in SF, NYC, people that are, you know, of stature, is there institutional interest in allocating to just straight up buying Bitminer as like I want exposure to ETH versus like the whole like invest in a venture fund or go buy ETH myself? Like, are you seeing real on the ground interest of like buying hundreds of millions, tens of millions of dollars of these stocks and like actually want to be like, I want to hold this for a year or 2 years, or kind of what are you seeing on that front?
I mean, think of it this way. If Bitcoin is the leading kind of playbook for every other crypto asset, Strategy is the leading playbook for every other DAT. And Strategy trades at a 1.7, 1.8 MNAV. They have run the playbook of equity issuance, debt issuance, now preferred share issuance. I would imagine every other DAT is looking at that and saying, okay, that's what we're going to do too. And so what will be amazing for the DAT ecosystem writ large is, once again, when Strategy gets added to the S&P 500, and then somebody goes, okay, well, I guess Ethereum's going to be in there too. And then Solana goes, okay, well, eventually I guess Solana's going to be in there too. And like that's kind of the playbook. So yeah, there's a ton of interest.
And like
leverage on crypto.
Yeah. And like you said, you know, there's significant demand from sovereign wealth funds, Norway, and, you know, that's the tip of the iceberg. But I want to clarify something on the S&P front, because I did a little bit of research here, and I'm of the understanding that a company has to be profitable for 3 quarters in a row, and then profitable, I guess, over that a longer period maybe. Is Strategy currently profitable? Because when I digged into this a little bit, it looked like they weren't. Eventually, I think you're right. I think they will be added to the S&P, but I think you were saying like January, February, December, Q1 of next year is when there's a timetable.
Every quarter, there's basically a rebalancing of the S&P 500 and 1 to 3 or 0 to 3, you know, additions and deletions. So like it's constantly getting rebalanced. In Q1, I believe there was a FASB accounting change that made it so that you can have accounting profit from these businesses that are holding assets. And so they are eligible to, this is the first time that they are eligible to be in. And it's just unclear as to whether or not they're going to make it in the first instance. Now, it is different in that they are not a traditional operating business, but that's up to the S&P 500's discretion, or the S&P's discretion. So it's likely that they will get added. It's just a question of when.
Right.
Yeah.
Got it.
Guys, I know we should have a couple minutes. I'm just going to play devil's advocate here. I put out a tweet that felt like an unpopular opinion, but I don't think it was based on the response that I got. But now that Michael's presenting such a bullish case, I think it may be unpopular for him, which was I tweeted that at the bottom of the next bear is going to be littered by the bodies and the blood of the digital asset treasury companies who are being forced sellers near the next lows. I think it's hard to see that right now. I think I get a lot of pushback for putting any bearishness out there. And so I've just kind of stopped. You know, is this something that you're actively concerned about from the lens of, look, something like some of these treasury companies are just buying businesses like whiskey companies, furniture companies, random things that are just completely not correlated to their to what is actually happening in terms of the accumulation strategy. Tom Lee, there's rumors of him buying call options with the money that he's raised rather than actually going and buying spot. You know, people lose money, stuff happens, lawsuits happen, et cetera. You know, is this a playbook that's going to happen again with GBTC, DCG type of thing? How are you thinking about the potential negative ramifications of this? And is that potentially a good signal looking ahead into the bear? You know, if there's another bear, if not just forever super cycle, you know, maybe we see a bottom signal there with some forced selling.
Look, I think the veracity that this DAT industry has taken off with over truly just like the last 90 days is pretty impressive. But bubbles don't form in 90 days. They take a really long time, and they have to be really, really big for them to actually kind of have systemic issue. And we're nowhere close to having this be big enough to where it could be a real systemic issue. This may be a systemic issue for a long tail DAT, which, you know, nobody's ever heard of and doesn't have any liquidity anyways. But if we're talking about the majors, you know, BTC, ETH, and what's rumored to be a bunch of soul DATs, it won't have a big enough effect to actually have any chance of taking down, you know, the token itself. And that's ultimately what matters. Now, if you have a bad structured note or senior secured assets, you could lose the DAT, and that could be something that happens, but it's not going to be something where, you know, and then congratulations, you get a bunch of shareholders who now own a bunch of assets. But that's ultimately what could happen. And so I think that's why I say we're in the first inning. Like, we are so far away from this becoming too big to fail. And if we get there, that's great. But if we get there, like, Bitcoin's at 1 million. Yeah.
Wow. That's fucking awesome. Comrade Michael, I'm riding this with you all in, brother. Let's go. Thank you for your time, man. Look forward to having you on again in a couple months maybe, and recycling some of this, seeing where we're at. Been a fan of what you guys do at Framework for some time. Also have a lot of mutual portcos and just, I think, similar ideas. So always around to help out. And yeah, appreciate your time, man.
Fun times, guys. Thanks for having me.
Absolute pleasure, man.
All right, man. See you soon. Rob, first take. What's your thoughts?
Bullish.
Bullish, right? I think I'm the bear in the room here.
I think you have bears in the room with you.
Oh man. First inning for the DATs. He's before the first inning.
I think your tweet about the bottom of the next bear is correct, because if you just look at the bodies from the last bear, it was the most levered entities.
It's just a matter of it being way too soon. It's like, you know, things are needing to get much more financially complicated before things blow up.
There's just so much liquidity that's out there that has not yet entered. Like, our expectation of scale is front running the actual liquidity injection into the market, right? Because we anticipate these things are coming. We hear rumors, we hear announcements, but TradFi tends to move a little bit slow. Like it still takes time for them to go and raise and ultimately fulfill these rumors and announcements and actually put the money into the market. And that's what ends up having the impact on the price.
Well, I mean, look, I think that he's right in the sense that this is still too small to cause a systemic problem. But, you know, any sort of issues here would like, I think he's right. Like we're not going to see a sharp drop off as a result of DATs stop buying. But, you know, if the ETH DATs have their MNAV consistently compressed, and that just like there's just going to be less buying. The thing that made me more bullish was that as long as Tom Lee can get this thing over 10 bill, he's going to go full sailor mode and just raise debt. And that's actual leverage. But as long as you can like be the first and be like, have a strong, like, it's crazy how Sailor has just created this like holy structure. And like, I don't mean to draw a pyramid, but like it's Sailor. And if he just keeps doing his thing, everybody else parties. If Sailor doesn't do his thing, oh boy, we are in for it.
I think Tom Lee is like as much a visionary as Sailor. Like he just got started later. I think Tom Lee's smart, man. I mean, he's been
I think he's really smart as well. But
on Bitcoin and ETH for a long
Sailor
time.
drew the playbook, man. He drew the playbook.
He certainly did. He was first. He kind of made it like he set the precedent.
So I don't own any strategy. I don't own any Bitminer. I only own Coinbase stock in my stock portfolio.
Yeah, but to own, like there's entities that are out there that are forced into like strategy and Bitmine rather than forced into spot Bitcoin or spot ETH. Right?
What do you mean, like if they get into the S&P?
I mean that like the Norwegian sovereign wealth fund like may not own, like they need a custody. If they are going to own Bitcoin, right? On the
they got to do a whole process.
Custody thing. They need there's so much infrastructure.
So they'd rather just own
hold
strategy.
Bitcoin of that size. They already have the infrastructure to hold strategy.
To own US equities, yeah. Well, that's the big breakthrough here for the whole space is like, you know, maybe we thought that sovereign wealth funds were going to be buying Bitcoin and storing it in their vaults, in their mountains of their countries. But the reality is more like, well, now that there's public equity access, it's much easier. So
anyway,
we got Colton.
Yeah, we do.
Go ahead. Yeah, we got Colton.
Yeah.
Coming up.
Colton's
let's get him up. Marketing at Aave. Has a track record in DeFi. They've just put out an announcement with Securitize for Aave Horizon. Aave's doing a lot of institutional stuff. Obviously, our boy Michael has just talked about their success and how he's thinking about them from the framework perspective. So we'll be a good one. Let's get Colton up in the back. Get him up here as well, and have some fun talking about what's the latest at Aave and everything in between. So, Colton, welcome to the stream, brother.
What's going on, guys? It's been a long time since I've been on this show. I was just saying backstage, the last time I was on this was about 4 years ago. I looked it up before I hopped on today.
Sick.
You guys were sharing a room and a microphone, leaning in and out together, taking turns asking questions. So
wow,
you've come a long way. Congrats on all the success over the years.
Yeah, it's quite the technical setup here now, isn't it?
Yeah, it's super sophisticated. I feel like I'm on a real show now.
There we go. Dude, I tweeted DeFi will win once again. I just keep stealing your line. Instant 50K banger. It's just every time, once a month, instant 50K banger.
Yeah, just take the free engagement. You're welcome. You're welcome.
Man, for those of you, or for those of our community who weren't on that previous episode back in the DeFi Slate days, maybe just a quick run through of your history in the industry, man. You've done so many different roles, had an interesting, dynamics. Give us a refresher on all the cool things that you've helped build and see through, and how you got to Aave.
Yeah, man, I've been in the space for a long time. I joined probably around. Well, I've been interested in the space for almost a decade now, but I actually started working full time in this space in around 2019. Really, I joined the Stellar Development Foundation, which is the kind of the stewards of the Stellar network. I spent a couple of years there before joining Liquidity as head of growth, and that's around the time we all met in the sort of like 2021 cycle. I led Liquidity to launch. It was one of the more successful launches that year for a CDP sort of stablecoin protocol. After that, I kind of spent a little bit of time at 1KX doing some portfolio support with their venture portfolio. Then I spent a couple of years at sort of Redacted, which then pivoted to Dinero. And then after that, ended up here at 𝘬𝘬. So it's been a long journey, but that's the TLDR in a nutshell. I've been focused on marketing in the space for a long time.
Awesome. Yeah, man. Last time I saw you, Colton, you were on stage at the 𝘬𝘬 DeFi summer event in Cannes, wearing a cowboy hat,
sweating balls.
Legends of DeFi, man.
Yeah, it was dope. I mean, that event was really cool. I think the venue was sick. I mean, it's an 𝘬𝘬 event. All 𝘬𝘬 events are as cool as they can get. The cowboy hat was actually a new thing for me. It was my boss Paris who recommended that. I think she was stereotyping me as a Texan a little bit, but I finally got the cowboy hat. I think it's somewhere behind me back there. But yeah, it was a fun time. I'm glad you guys made it out.
Yeah, man. Absolutely. So you were able to go 0 to 1 at Liquidity, and that's where we met. You know, you had a great experience there. Now you're taking 𝘬𝘬 1 to 100, right, and helping them scale. How is the experience different working at a company that's going 0 to 1? You're a smaller company, you're working on the launch, you're working very tightly with everyone in the company. Fast forward to 𝘬𝘬, bigger company, so much going on, so much success already, but now taking it to another level. Like what's the difference in experience and the difference in skill set that someone needs in order to apply those skills to these two different parameters?
Man, coming in hot on the first question. I would say, whenever you're taking a protocol 0 to 1, like we were doing with Liquidity, you're really just fighting for like the next 10 users. You know, you're trying to build like that core user base of whatever, 100 to 500 to 1,000 people. And if you get that, you feel like you've won. Whereas obviously at 𝘬𝘬, where there's been whatever 2.5 million users have interacted with the protocol, probably more at this point, you're really trying to focus on where the next million users. And so we spent a lot of our time thinking about like, how do we access that those people? Where do they come from? You know, 𝘬𝘬 is already the biggest protocol in DeFi. It kind of owns like 60-something% market share in DeFi lending. And so now we're really trying to focus on where the next user set is going to come from. And so a lot of that has looked like the thing we launched yesterday, which is the Horizen RWA market. It is specifically targeted towards institutions. Right now, I know you guys track RWAs a little bit. And so like institutions are currently moving on chain. Right now, they don't have a ton they can do in DeFi. Well, now they're able to actually unlock liquidity against their various RWAs that they hold through Horizen on 𝘬𝘬. So we're doing a lot of stuff like that to figure out like, how do we get more capital on board? How do we get more users on board? In terms of the skill set, I think like you really have to look at what some of the more successful fintechs are doing. Whenever you're taking a DeFi protocol 0 to 1, you can really just focus on DeFi language. You could focus on going after people like yourselves who are kind of already in the space, already deep in the trenches. But whenever you're at a protocol like 𝘬𝘬 and you're going after the normal people, you have to look to the Robinhoods, the Revoluts, the banking apps, etc. You have to look at what they're doing to go after users and kind of mimic them in a way. So it's not really a change in skill set. It's more of a change in approach. And so you just kind of have to mirror what some of these more successful folks are doing outside of DeFi to kind of go after similar audiences.
Yeah. I mean, look, 𝘬𝘬 is getting, you know, I've kept seeing this chart that you guys post with the different banks that you guys are just scaling onto. And I think you guys are top 40 now.
Yeah, 38, I think. I think people actually, what's pretty cool is 𝘬𝘂 put out a bounty the other day and asked somebody to build a website that tracks this in real time, because I was just kind of making those graphics on the fly. And so if you go to 𝘬𝘬rank.com, anybody who's watching this, you can kind of see 𝘬𝘬 flipping banks in real time, which is like an insane thing to say in 2025. So
shout out to our guy Hubi from L2Beat, who I think did create that. I saw his quote tweet of it for Sell app.
Yeah.
Vibe coding, man.
Just
vibe code anything these days. So Colton, tell us a bit more detail about the strategy. Like 𝘬𝘬 is, X today. We need to get to Y in 1 year. What is Y and what is the strategy to kind of actually get there? Like Securitize, Citibank, Fidelity, stablecoins, Go, Horizen deployment, multi-chain deployment. Like what is the, you're in the boardroom, you're in the war room, Stanley, Mark, you guys are talking, like, what is the strategy that you can share?
Yeah. So some of the strategy, I mean, on the L1, L2 side, it's about putting Aave in front of users. And so I think Aave has this very, like, for the most part, this very unbiased approach to where it can be deployed. It's a little harder if it's like a non-EVM chain like Aptos, for example. We spent a long time building that out. And so we're starting to scale that market slowly. It went live just like last week, I believe, if I'm remembering my dates correctly. And so we're trying to go where the users are in terms of L1s and L2s. That's pretty straightforward. Almost every dApp is doing that right now. I think where we're trying to find the edge a little bit is with integrations like the one we just launched with MetaMask, which is MetaMask stablecoin earn. So if you are a MetaMask mobile user, you can literally start earning yield on stablecoins in like 2 seconds. If you're holding stablecoins on MetaMask mobile, you just have to click like 2 buttons and you're deposited into Aave earning yield. And they combine that with their MetaMask earn card, where you can basically earn yield up to the second you spend your Aave USDC, for example. So we're trying to do more cool integrations like that. So meeting users where they are. And then another big piece that we're focusing on is kind of trying to onboard these fintechs and really embrace this like DeFi mullet idea. We're starting to see the Robinhoods, the Revoluts, et cetera. They're getting into DeFi. We want to go after those players. You know, it doesn't make sense for them to build like on-chain lending infrastructure from scratch. Why would you do that? Especially whenever Aave has super deep liquidity that can accommodate, you know, the average retail user, but also the average whale. And then honestly, the average institution at this point, you can, you know, borrow tens of millions up to 100 million or so dollars and not really affect the protocol very much. So I think that's the summary of the strategy. I mean, obviously there's lots of tidbits here and there where we're focusing on different things that I think you'll see more of over the next year. Obviously, we're also working on Aave v4, which will be more composable and more accessible for builders. But that's kind of the TLDR, I would say.
I had a pod with Stani about World Liberty Fi, and he explained the concept of friendly forks, which I didn't hear you mention, but I have a feeling it's sort of the injection or implementation strategy of Aave into the Robinhoods and some of these more traditional financial institutions. Like, what is, if it's not friendly forks and kind of embedding Aave into a different distribution channel, what is the integration strategy with the Robinhoods of the world?
By the way, guys, real quick, the friendly fork has like a 5x multiple on Aave's FTV. Just a heads up.
And
it goes like that. I mean, what do you do? It's a Trump thing, you know, what can you do? Unfair advantage. But yeah, I think like the friendly fork thing is interesting. It's still a framework that is developing. I think some of Aave's scaling will look like that. Ultimately, like ink is doing something similar on their chain. And so any team, I guess, that would want to do some very custom functionality on Aave before V4 would really need to do this friendly fork model, and that gives them more experimentation capability. You can't really experiment as much as you would want on the current Aave market because there's a lot to lose there. But for some of these other teams who want to be very experimental or have more granular control over the market, a friendly fork is a good option. But I think for some of these Robinhoods and Revoluts, et cetera, if they don't want to fork Aave, then it makes sense for them to just offer very basic functionality on top of Aave. Like recently, Robinhood, for example, did that massive campaign where they were trying to attract crypto deposits, and they did that, whatever it was, 1% to 2% match. Now they have a ton of people on their app holding, you know, whatever Bitcoin, ETH, et cetera, or maybe even staked ETH. And so it would be very intuitive for them to use the new like SDK and APIs that we released in order to just offer Bitcoin-backed loans directly in the app. That's like a very seamless experience. And so I think that a lot of that will be the play for some of these fintechs. They can kind of dip their toes in the water without doing some full commitment, because doing like a friendly fork is, I mean, that's about as in the weeds as you can get. You kind of have to manage the risk parameters. You have to select the assets and all the rest. And these teams have so much stuff going on. It's more straightforward for them to just plug into what Aave already has to offer.
And we've seen the friendly forks across multi-chain deployments, and a lot of them have just failed.
Yeah, it doesn't always go well. It's not easy to run a lending protocol.
That's why Aave exists, you know?
I think maybe the other side of this is that they want to capture a lot of that value. And so it's a way for them to maybe capitalize on it. Obviously, a lot more customization that it takes. But are you seeing when you're kind of experimenting with these companies? Are they more hands off? They want to leave it to the trusted guys. That's Aave, or are they a little bit more in the weeds and hands on?
You know, I think I saw a tweet from, maybe it was like Anthony Sassano or something yesterday, where he was talking about how like institutions are in a 2013 era when it comes to DeFi. I don't think I've seen that behind the scenes. I think they're actually moving way faster than most people think they are. And so what I'm seeing, and what I think a lot of teams are seeing, especially with like all of the DAT stuff that's been going on with the NASDAQ and all the rest, like these teams are just ready to go. And so whatever kind of compresses that time to market is what they're most interested in, because they have to beat out everybody else. Like all the fintech apps are still very much in competition with each other. And so whoever's first to market on a lot of this might be winners take all or winner take most, like we've seen in DeFi and like we've seen in crypto at large. So I think a lot of them are going to want to move fast. Some of them are going to want that customization and all the rest, but I think I'm seeing people move way faster than most expect.
And I'm curious more about Go too, because the other crypto native protocol that is surpassing banks is Tether. Obviously, stablecoins are core to their strategy. They've been able to amass a significant amount of deposits. How important is Go to this strategy as you guys are moving up the ranks when it comes to these banks? Like you're continuing to see adoption. What's your take on Go? Where do you think this goes?
Yeah, nice, nice fun.
Fun
Fact on USDT. I think there's like $8 billion of USDT on Aave too, which is like an insane statistic. It's like 3 to 5% of the total circulating supply, which is ridiculous. Bullish. Yeah. So on the Go front, I think what's pretty cool about Go, and you know, this kind of has to do a little bit with the revenue meta, is that Aave DAO. Go is like a huge revenue driver for the Aave DAO, because 100% of the interest that's paid on Go borrows is paid to the DAO. Whereas, you know, with regular supplies or whatever on Aave, there has to be a split between users and the DAO. So I think from a revenue perspective, the Aave ecosystem is very incentivized to grow Go. And we've been doing that a lot lately. I don't know if you guys have seen all of the integrations that have happened lately with like the Fluids of the world and all the rest. We also launched this Go savings product where surplus revenue from Aave DAO is redirected to Savings Go. And so I think like right now it's paying out like 8% or something like that on, you know, almost $200 million. And so now we have this competitive Go savings product. So that's a big part of the strategy. And then from there, I think what's pretty cool about Go is that you can kind of almost like you can redirect where you kind of want liquidity to go by saying, like with Horizon, for example, we can allocate 1 million Go to be borrowed by Horizon users. And so in the event that we're not getting maybe a ton of stablecoin supply in particular markets, Go can be used as a stopgap in the meantime, which is kind of nice. So I think Go is like just this very nice feature to have in Aave. It's kind of like one of those type wins where we own the whole stack as Aave ecosystem. We can incentivize growth. We can offer this savings product. We can kind of control the future of Go and make it just a nice touch on the whole Aave product suite rather than like make it the main focus.
Yeah. I think there was some struggle there with Go on the initial launch for the first year or so with the peg, and then it seems like that's really been cleaned up. And is now kind of getting sophisticated in terms of potential usage and all of that. And you know what's interesting is, you know, there's a world where a lot of these Ethereum DATs keep growing, and a lot of this liquidity comes into Aave on chain.
Like yeah, well, we're already starting to see. I don't know if you guys are familiar with BTCS, but it's a NASDAQ traded.
Yes.
I don't know if it's a DAT. I'm not familiar with all these. Yeah, they bought the pudgies. But they actually do borrow on Aave.
There you go.
I think like one of the things with some of these companies that I've actually learned recently is that whenever they pivot to a treasury company from whatever they were doing before, they're actually pretty limited in what they can do, particularly on chain. And so I think whenever you just buy ETH and stack it in the treasury or whatever, that's a very simple like economic mechanism. They're kind of just allowed to do that. I think it's treated similarly to like cash on the balance sheet. But as soon as you start doing other stuff like borrowing and leveraging and all the rest, then it becomes a different game. And so many of them kind of have to wait from the moment they pivot to a sort of treasury company. I think they have to wait 6+ months before they can start doing more exotic stuff and kind of redefine what the company is. And so I think we're probably a few months out from seeing more interesting experimentation from these companies.
Interesting. So buy Aave now. Financial advice. No, I'm just joking. No financial advice. Do your own research, guys.
Yeah, it's like you're gonna have to call your lawyer after this, Andy.
No, but I think that I didn't realize that was actually so that just means that the downstream effect of some of this capital coming on chain is a couple months out. Which
yeah, it's going to lag because right now
Yeah.
I don't even think many of them I think are limited to staking in custodians as well. Like most of them don't even have their stuff on chain. But the difference is BTCS, they've been doing this I think for like a decade or you know whatever. They've been doing it for a long time. So they have way more flexibility and they're doing all kinds of stuff on chain like staking with Rocket Pool, leveraging on Aave, buying pudgy penguins, etc.
Yeah.
A guy in the comments from Precog Market says, Petra, he says, we want to enable long-term prediction markets at Precog Market by providing yield to users by integrating Aave. What do you think, Colton?
I actually asked a couple of people internally this the other day. I was wondering why Polymarket doesn't just have all of the USDC sitting in Aave. Like, I don't know how much they have just sitting on the platform. I don't know if users frequently deposit and withdrawal or kind of what the user flow typically looks like. But yeah, I think it's a great idea. I think it makes sense for cash that's sitting in a protocol. If it's not being used, Aave is kind of that as close as you can get to a risk-free rate in DeFi.
Yeah.
And so I think it's a huge win for a lot of these protocols that just have idle cash sitting by. Like, it's a small benefit that you can give to your users. And I think, like, you know, the way inflation's going, and if the money printer turns on soon, people are going to want access to yield as much as they can get it. So might as well offer it to them. You know, it could always be opt-in too. You don't have to like force it on users if they don't want it.
Well, there you go, Petra. If you're watching this, DM our boy Colton for some BD.
Yeah, I would love to chat about it.
Yeah.
And Eric Trump just went into Polymarket, so now we just run that through the World Liberty 5 back channel, and it makes its way to Eric and Polymarket, and they deposit all that onto Aave, which I was thinking about this from a different angle, but
Crazy transition coming here.
So I was
let's see where this goes.
this latest Arthur Hayes article, right, which also describes how the interest rates are going to go lower. Obviously, the only place to go and get some yield on ETH is to go and stake it on chain, but for all the companies that are looking at sitting on stable coins or even stable coins like Polymarket, I mean, they could be going and getting yield on traditional cash markets. But if these rates get cut, Aave's yield looks more and more attractive. I mean, this is just kind of like emphasizing your point earlier about that lag and how that there could be a couple of other boosters here. That emphasize that.
I agree. I think like it. I mean, especially I think this is a good example too of like why DeFi is a better place to save your cash on average if you choose the right protocols. Because like whatever, I don't know how often the Fed does these meetings, but we all like gather around and wait to see if he's going to cut the rates or not. And he may or may not do it, and then he'll give a hint that maybe he's going to do it. And it's like, dude, I can see what I'm earning in real time and then get paid out by whatever the block on Aave. Like, it's just way easier. And I think like you start to see a lot of these savings apps that are being built on top of protocols like Aave, and that you deposit your cash and you literally just watch the number go up in real time, because that's how interest is paid out to the users. Whereas in my like high yield savings account that I might have with a bank or Marcus or whoever else, I'm waiting like every month, I'm waiting for a payout. And then I have no idea if the Fed's going to like rug my yield. And then for some, depending on what you're in, you might try to do a withdrawal and you might have to wait a month or whatever to get your money out.
Yep.
So it kind of sucks using all the TradFi stuff. So it'd be cool to see people pivot to DeFi just for savings in general. It's a more clean experience.
Yeah.
Should we anticipate like a mobile friendly consumer banking app where we can just deposit cash? You guys convert into stables in the back end, deposit into Aave?
Would be cool. We have the family app now, but I think there's going to be a lot of stuff from us over the next whatever year. And so I mentioned that we do want to go after the next 1 million to 10 million users. I think consumer is going to be a part of that. B4 is going to be a part of that. Institutions are going to be a part of that. So nothing is out of the cards.
Beautiful.
Soon,
Well, 𝘗𝘓𝘧, man,
𝘗𝘓𝘧 I got one last for you.
Run this back in 4 years after Rob's last question.
Last question for you. We've had plenty of conversations with 𝘬𝘂, but he's a great guy, and you work with him closely. I was curious, is there any wisdom you've had from working with him that you've taken to heart and has helped you?
Second hard question today. Actually,
I
would say, I would say one thing that's caught me off guard about 𝘬𝘂. And this was kind of a bias I had about like going from working with 0 to 1 protocols to like a bigger protocol. I expected it to be like a little slower for whatever reason. I expected the stakes to be higher and the timelines to be slower. It is not like that at all. The stakes are very high, and 𝘬𝘂 likes to move extremely fast. And I think there's value in that. Like, it would be easy for Aave Labs and the Aave ecosystem at large to like sit on our hands and be like, okay, we're the biggest DeFi app by a lot. We're the most successful lending app or lending protocol by a lot. We don't really have to do that much. It's kind of, you've seen other protocols do this. I don't want to name names, but like 𝘬𝘂 is not like that at all. And it's actually pretty motivating internally to have somebody that's like constantly looking back and be like, all right, we have competitors that are 10x smaller than us, but we got to keep moving. And so I would say that's the biggest piece of wisdom, is like never rest. It's like winning is not an end state with the way the current market is and with the way fintech is. The space is constantly evolving, and if you just chill, you're gonna lose. And we see it time and time again, cycle after cycle. That's why a protocol like Hyperliquid, for example, can come in and start just one-shotting centralized exchanges. It's just like, that's crazy. And it's because centralized exchanges in many ways have kind of sat on their hands and started counting their chickens before they hatch. So I think that would be the biggest piece of wisdom I've gotten, I think.
Yeah, very cool. Thanks, 𝘗𝘓𝘧. No more hard questions.
Cool.
You did
well,
it. Two for two.
I appreciate it, guys. Yeah. Hopefully we can do it sooner than 4 years.
Yeah, let's do it.
I think maybe Buenos Aires will be the,
right.
Yeah, maybe then.
Yeah,
you guys will be there.
We'll see you there.
See. Vamos.
Let's do it. Awesome.
Let's go, brother.
We'll chat then.
All right, dude.
All right.
Much love. Congrats
All right,
on the new role again, and all the success. It's not that new anymore, but it's new to me.
Yeah, likewise, guys. All right.
Alrighty,
take it easy.
Cheers, brother.
Bye.
Alrighty, Rob.
Banger.
That wraps up our
off.
guests of the stream. What a great last guest. Good vibes.
Last stream of the
pretty good
week.
stream today.
Good times. Good vibes. Market's in a great spot. You're the resident bear. You're calling top. I don't believe it. Stop changing the limits.
Buddy.
Buddy.
You don't even know. You don't even know what's going on, man.
Before the first inning, singing the national anthem. That's what we're doing.
You think we're still singing? Kanye West just launched a meme coin. You think we're singing the national anthem?
It got dumped. It didn't get bought, which means that mania and euphoria is not here.
You think Trump launched a meme coin 6 months ago? You think we're still singing the national anthem?
We are 6 months into his term. 7 months.
You think we're singing still? I think the fat lady's singing. That's who's singing. I'll see you guys next week. Thanks, guys. Peace out. All righty.